cautiously optimistic about the fixed income markets for 2020. Why? Well, it feels like we've passed that point of maximum pessimism. We are hearing talks of a trade deal. We feel like Brexit has moved to the next step. Even the Fed has come across and said they're done. They feel like markets are stabilizing. That's all good news because that should allow what the central banks have done to date, which has been easing pretty much across the board. That should allow that stimulus to keep the US out of a recession and quite possibly bring the globe along with it. I think where we're going to see the bright spots in this what feels like somewhat overvalued market is in the fact that we're starting to see some breaks in between credit quality. Triple Cs have underperformed the rest of the high yield market. There are pockets within bank loans that just aren't seeing the love. There are pieces of the triple B market that are in what we call no man's land, don't seem to be able to find a bid. Where we see the bright spots and the opportunity is in that volatility and the lack of liquidity that's in the markets. Credit fundamentals are definitely something we're keeping a close eye on. Profits seem to have stabilized. Leverage is definitely on the higher end in some levels of the debt markets. Covenant protection isn't as good as it always has been. These are all the types of things that you would expect to see late stages in the market when everyone is really reaching for yield. That said, I think that what we're going to do is focus on those areas where all the debt has come. So over the last few years, as the high yield market has actually been shrinking, what we've seen is a huge amount of borrowing in the triple B market. And for us, as active bottom-up bond pickers, we will do the research and be able to discern between those that are representing value and those that we should avoid. What I would expect from the Fed in 2020 is for them to do exactly what they've told us. They've told us they're going to be on hold. Why do they want to be on hold? Because they don't want to use their last bullet before we even get into a recession. And we think that monetary policy is loose enough. We believe, due to several other things going on in the background, the more stabilization of some other policy, particularly trade, that should be enough this time. What I can assure you of is that if that changes, if we backtrack on trade, if there's a big geopolitical event, the Fed is ready and I think willing to do what they need to do to keep the ball rolling in the US economy. Emerging markets have been a really tricky place over the last couple of years, and I would expect that to continue. Until we see a real stabilization in commodity prices or even a lift in commodity prices and global growth get off the ground, it's going to be hard for emerging markets to really be a place to find true value. The only thing that's giving me a little bit of hope is that we're really starting to see volatility within the emerging markets. And given that, we might find small pockets of value. Our currency outlook for the coming year is pretty sanguine. What we see right now is rate differentials, especially with the Fed on hold, still favoring the US dollar. Growth still favoring the US dollar. With that backdrop, it's really hard for the US dollar to be that much weaker. I don't believe at this point that there is a major reason for a big rally in the dollar, nor do we expect it to reverse course. So the big macro risk that we're focused on right now is what is the right policy response? We're getting more and more concerned with the negative yielding debt, with the low yields away from the negative yielding debt, and the inability for monetary policy to fix what the world is facing going forward. We need fiscal policy. We need cooperation. We need everyone working together, not just the central banks, to make the world a more stable place.